Let's talk layers, and to do that, we're going to look at a trade that's just closed on Friday, yesterday, from the new layered Fast 50 U.S. equities pairs. And the companies are Levi Strauss & Co. versus Ralph Lauren Corporation. Those are two big brands everyone should be able to recognize. Well, that trade lasted 18 days. It made $507.43 based on our backtesting and out of sample live signals. And that was about a 12.7% return on margin if you were trading with 5-to-1 CFD leverage. Now, we're going to drill down on why it is that we use layers and how those can improve reward risk for you and reduce your maximum drawdown. So this is the pair Levi RL. First off, why did we choose it? Let's quickly look at the fundamentals. We'll pull up a fundamental snapshot, and then we'll also look at the chart action on this and see how the trade developed and when you could have taken it when we launched these new layered Fast 50 as of Monday last week, which was 19th of July. So Levi Strauss & Co. versus Ralph Lauren, we can see that the beta isn't available on Levi, but likely very similar. They have a share price of 110 and 26. That's within sort of 6-to-1, 7-to-1, so we're okay on that. Market caps very similar. Let's look at the EV. So we got 12 billion EV versus 9 billion. And what we really want to see is that the market's generally valuing these franchises in the same way. If we look at EV to sales, it's pretty close, 2.4 to 2. And if we look at price to sales, we got about 2.2 to 1.9. So broadly similar view of the two companies. We do have a bit of a difference from a fundamental point of view from Zacks. It's valuing Levi's as a higher momentum play with a better set of fundamentals than Ralph Lauren. But we'll put that out for you to decide whether you'd want to take a trade. You would definitely want to take it if Levi was the long leg and Ralph Lauren were the short. If it's the other way around, up to you to decide whether you would. So Levi Strauss & Co., I think everyone knows this. They make Levi's, Dockers, Signature, and they sell them all over the world through their own branded stores. Ralph Lauren Corporation does pretty much the same thing, although they go into higher end clothing items as well, and they go into homeware. So slightly different business model, but generally speaking, very, very similar businesses. So that's why we chose them. And how did they look in backtest? If we look at the backtest, it'll let us to choose them. Over the 2-year backtest period, there were 8 trades. They were over 72% correlated. Co-integration of the period was 0.99, so highly co-integrated. The compounded growth rate for deploying the capital in this pair and nothing else over the 2 years was 17.28%. Max drawdown 11. Gross profit of 4,000. And average net profit of trade of about 469, very much in line with the result we just got. And 100% of the trades were winners. You'll see here it's in a slightly negative position on the equity curve when this backtest was done, because the backtest was concluded on the 16th of July, and we launched this set on the 19th of July, last Monday, as I mentioned. So let's take a look at the pair charts to determine what happened. So when we launched these, you can see that if you look over here, 19th of July, this pair was already in 2 layers and was at a loss. Okay, so you could have replicated this trade when we launched, and you would have been in a better position than even this loss figure. So if we look at over the last year, the ratio chart, we can see that there was a 2-layer entry here and an exit, single layer entry here and an exit, very good trade. 2-layer entry here and an exit, and then the one we're just looking at now is 2 layers and an exit. What do we mean by that, by layers? Well, let's take this one, which is what we're talking about today, as an example. So on the 6th of July, there was a trade called to go short Levi's, long Ralph Lauren at 2.43. That's the first entry layer of our layered Fast 50. And so the Pair Trade Finder Pro Analytic did that, entered that trade. Then on the 14th of July, the trade degraded further and went to 3.28 standard deviations. You can see that over here, 3.28. And what we did was we entered into another layer. So it entered the same trade again, scaling in with another 5,000 a leg. And that was done at 3.28 standard deviations. Now the loss at that point was over almost $400. You can see why. The ratio's gone way against you. But you're taking that, and if you see the RSI, it's now at a very heavy extreme. What is worth pointing out is that you had a higher high here on the ratio line and a lower high here on the RSI line when the first entry happened. So that was, that was a very positive thing in favor of taking the trade. So what happened? So PTF Analytic decided to come in for a second leg for another 5,000, doubling down, scaling in, and the trade came good, and it came good very quickly, so that by the 23rd of July, yesterday, we made $507.83. So if you look at this, had you been in just the first leg with 10,000 a leg, you would have made some profit. Okay, not a big one, but some profit. However, because you got into 5,000 here and 5,000 here and then exited here, you made a lot more profit. So 507.83. What's also important, and I really want to point out, is that had you put all your money in here, 10,000 a leg, by the time the ratio got to here, you would have had a very big loss. You would have been about 800 in loss. And that would have been a very uncomfortable position. And some of you, if you had a max loss stop loss, it might have triggered it, depending on what your levels are. However, by layering in like this, the loss was limited to 400 and then came out with a 500 profit. So that's what we mean about reducing the maximum total drawdown on a pair, because you're scaling in as it goes up. And also improving reward risk, because you've made more money because you got a better entry here on the second leg than you would have had you just come in at this one and exited here. So another very good example of this would be this trade, the previous one. Let's take a look at that. So because you layered in, had you come in here at 10,000, you would have gone way offside, maybe triggered a stop loss. And then when you finally came back in and exited, you would have been in a slight loss. However, because you did this layered strategy, 5,000 here and 5,000 there, by the time you exited, you had an almost $300 profit. So again, you reduced your maximum drawdown and you increased your reward risk by using the layer strategy. That's why we wanted to highlight this pair. So that's a very quick look at Ralph Lauren and Levi's, the layered Fast 50 US equities pairs. We can call this trade of the month if you want. And it took 18 days and delivered $507.83. And we launched these pairs on Monday. You could have come in at that point and you would have done very well out of this trade. Hope you enjoyed, and happy trading, everyone.